Something so unusual in markets just occurred that we need to discuss it together. 7 weeks up in a row. And with the Dow Jones registering its best weekly win streak in over 6 years, it's hard to see any bears in the markets anymore. But should that mean that we are most cautious now? And also, what is smart money doing in comparison to us being the dumb money? Are they buying or are they rotating? Today, we talk about everything to do with markets moving forward through the week, including stocks, commodities, and cryptos together. Well, welcome back everybody to The Daily Show. My name's Tom. We've been doing this for over 3+ years together. And if you love markets like we do, remember to subscribe and smash that like button. Let's move through rotation for the week in history. Of course, it was really a sign of semiconductors going up massively and the rest of the market coming along for the ride. If you were in the Mag 7, they did not perform as well as you might expect. And we've got some dark pool liquidity that's been going through on some of these that we'll bring up later on in today's show. But let's get into the fear and greed index, because straight away you're going to be saying, well, we must be in extreme greed. Well, according to this index, we're still just in greed and we haven't ticked over. And that may have some of you scratching your head because you're like, what is going on with these markets? They cannot surely go up anymore. We do have the stats on that coming up in these unusual circumstances. But let's talk rotation. One of our favorite sectors recently, solar, has been absolutely going bonkers. And you can see here that when we take a look at the last 5 days in the market, we have solar, clean energy, and also regional banks out in front. Now, I want to focus in on regional banks for a moment. We've got a great chart coming up later on because if you didn't know, almost 20% of the Russell 2000 is made up of regional banks. So when we see regional banks flying high, that means the percentage of the Russell 2000 stock starts to increase to new day highs. We've just seen all of them registering a 63-day high, and this is a very unusual piece of data that we don't see too many reads on. Here, when we go back all the way into history, back into the 80s, you can see that we actually have a few reads. And when we get them, it tends to lead into a pretty positive time moving forward for the Russell 2000. In fact, 90% of the time, we've been positive over the next month, and we've been 100% of the time positive in similar reads over the next 12-month period to a pretty good degree. So what could this mean in store for your particular portfolios and trades next? Well, I'd also like to remind everybody to subscribe to our free VIP weekly newsletter. Links in the description down below, because we have a new one coming just before the Monday open, which I think might surprise you. Let's go through smart money versus dumb money confidence spread, though. I've updated this chart a few times, and obviously you can see here that dumb money is getting wild. In similar reads, we've actually been able to drive higher, even though we've had such big divergence between smart money and dumb money. But it is at a point now where it tends to lead into the next 2 months being turbulent. Even if we run higher, there's usually some kind of crash or mini correction that's just around the corner. Let's take a look at what happened, though, in the previous week. We saw smart money start to pick back in, and a lot of this is actually driven by CTAs, which we've got the data on a little bit later on. They chose to get back into the market, probably something to do with OPEX and also missing out on some of the gains into the end of the calendar year. They've got to make those gains so they can get those fat paychecks, yeah? Dumb money confidence spread. Have a look at this. Some similar reads in the past, 3-month pullbacks in similar read times when we saw dumb money get this high and this overly extended. However, there was one over here back in 2020 where we actually continued to see rallies throughout and not really a significant pullback in the market. Remember, nothing is guaranteed, and you have to bring together the weight of evidence, which is what this show is really about. As we mentioned, CTAs have actually started to increase. We talked about this in the previous week because we had that chopping market, and then we start to see CTAs decline. But as the market broke through that high, especially thanks to Jerome Powell's speech, they just went back in. And if this starts to increase over the next couple of weeks, markets could drive higher. But we do have some options levels that may stop the market in their tracks moving forward. They're coming up as well later on today's show. I wasn't kidding. There's a lot of stuff to go through here today. What about fear and greed? Well, when we start to look at the markets, you can see here that we often use moving averages and percentage of stocks above certain moving averages. Above the 200, above the 50, and above the 20 are often used. And you can see that breadth is definitely improving because that's above the 200, and that's now sitting at highs that are often synonymous with turning points in the markets. Now, the one problem with that is going to be that it's too early to tell that we are at that high that needs to be turned. Remember, price action is going to be key, and I'll update this chart on our X as well so you can check it out as we move forward. I thought it would be a good time to put in a quote that I've put the last 3 videos because it's very unusual to see the stock market index to go parabolic. We do often see it in stocks, but not the indices across the board. Parabolic advances usually go further than you think, but they do not correct by going sideways. Bob Farrell's rule number 4. What this is basically telling you is that there is going to be volatility in the future, and we're going to see some pretty wild moves at some point. Let's now have a look at something Wayne's done here with some data because I think it's pretty cool. And what he's actually gone through is he's gone through since 1950 when we've had similar 7 weeks up. What do we tend to see next? Now, you would instantly think, okay, we're probably going to see the market crash off. And in the week after the 7th week, we have an 11 up, 9 down kind of read. So that's like a 50-50 read. Yeah, pretty close. However, over the next 4 weeks, we actually have 16 times up over 20 reads and only 4 down. So it's suggesting that there's more to come in a rally such as this. What do you think in the comments down below? Is that even possible with reads such as this one from the sentiment reader? Well, yeah, it looks like we'll have to be looking at every single bit of evidence moving forward. And of course, price action will be number 1 on that list. Let's talk about everything to do with what direction do members do sentiment trading, retail traders think is going on right now. The lowest bear reading in over 6 years. We also have a bull reading that's over 50%. When I've seen over 50% bull ratings, I am ultra cautious and obviously rotating very heavily through the market. Indices tend to be one of the hardest trades around these periods of time, and I think you'd already suggest that by looking at the charts. Now, some of you are probably saying, dude, it's really easy. I just buy calls and make money. Yeah, but when you're trying to talk about replication, you're not always going to have a market like this. Let's talk about costs of puts because generally speaking, the calm before the storm is often what we need to be careful about. Now, put protection is at one of the lowest pricing ever, according to Goldman Sachs. Basically, that means that you can protect your portfolio for incredibly cheap prices right now, and selling puts would be one of the worst concepts at this stage. Risky credit as well. I was looking at some of the bonds around the world, and some of the credit spreads are not even worth it. Credit offers very little compensation. I agree completely. There are literally some bonds that I would consider risky that are now really cheap in comparison to the risk that I think is on the board. Well, that's going to be an interesting one because we know that never usually ends well, and 2024 will be wild due to bonds, I feel. Small cap versus large caps. We've already talked about this rotation. We brought up some interesting stats for the Russell before. Do remember that from December the 11th to February the 11th, it tends to be a small cap kind of period of time in the markets. And we also have that based on the calls, which have been running around all over the charts. A lot of people looking at calls opened on the Russell and saying, well, it's got to come down. Well, history would tell you that generally speaking, these are pretty powerful moves for the Russell. So again, one of those things that we've seen. We've already actually done the 8% in only a few days. But yeah, it's something we've been talking about now for over a month. Here's, of course, the stats. We're now at the middle of the month. So traditionally, you usually see a run-up of the Russell, or at least the Russell would outperform the S&P. And it's something that you need to be looking at on the charts. Speaking of charts, let's go back in history. So these are some that are going around right now. Now, this, according to people, is that Powell has declared victory on inflation. And of course, we also had Volcker declaring victory back in the past. Now, from that point, markets actually went parabolic and then they went into a sideways chop for a period of time. I don't know if it's going to be the same as this, but I thought I'd chuck them in the video because, of course, there's also another one which is similar in terms of breadth or switch ratings, and that's coming from, of course, banks supporting this move, which you can see here based on this kind of basing formation that we have in 2020 and 2023. So not only is supposedly the central banks claiming that they've beaten inflation, according to people out there, but on top of that, we're getting similar reads with base formations. Everybody's turning bullish across the board. And now everyone is super bullish. And of course, this is when you have to get most cautious and start looking for the price action reasons. From the dot plots, we also gained that basically the Fed was going to think about 3 rate cuts. The market's saying 6 plus for 2024. And do remember, the market tends to price in advance the rate cuts. So by the time the reality of the rate cuts comes, it's a buy the rumor generally and a sell the fact. If 2024 plays out like normal election years, and there's been a few charts that we've shared in our newsletter, then it would usually be a fairly good year. Remember, if the market closes a plus 15%, that's the S&P, for the calendar year, then we do tend to get a very good run in 2024. I think it's plus 10%, which is already unusual, is well over 50% of the time. This is usually what happens when the Fed does do a rate cut. We either get a sell-off market or a gaining market. One thing to watch here is going to be EPS and in general, the expectations of the street on what's happening with earnings. So earnings is going to come into focus a lot in 2024. If they do not see the right earnings on stocks, I feel like some will sell. Are there still opportunities in the markets? Yeah, this is a few weeks ago now, this chart, but it just shows you that outside of the Mag 7 was the place to be looking. And so far, we've seen rotations into gold and then out of gold, and we've seen rotations into heaps of laggards across the board. I'm not going to give up on the Grinch as a possibility as well. +3 and then +3 before Christmas, +3 after Christmas. When we get the Grinch, that's going to tell us a little bit of data around 2024 as well. We'll bring that up again in the future. It's good work by Wayne there. We also have this one, which I keep putting in the charts just because I think it's interesting. Moody's downgraded China once again, and when they do it, it tends to be a positive period for that market. Now, everyone makes a joke about this market because, of course, since 2020, everybody said China's undervalued, China's undervalued, China's undervalued. But could it really be undervalued? Well, according to Moody's, it's done, it's finished, it's over. Yeah, all right. Well, we'll see about that. But of course, price action could be an interesting point for that one in 2024. My point there is really that whenever you get downgrades and upgrades, you really have to look for the price action, because if you get a downgrade and then the price action goes bullish, I think you know where the real money flow is going. Speaking of real money flow, my favorite stock, what's going on here? Why is someone selling it? Or maybe they're buying it. Yes, Microsoft put in a massive trade, but just remember, a lot of these reads do tend to happen over OPEX, as there's a lot of settlement of stock that needs to go on with the trillions of dollars. We also saw Tesla putting in a massive trade. It's been a while since seeing a massive trade come through on Tesla. More on this chart coming up later on today's show, so we'll talk about that soon. We also had another one, AAPL, Apple getting a big trade on it. Could this be sellers in the Mag 7? And then we have Russell 2000 putting in massive prints across the board. Now, this has been a point. Not only is it a resistance point, which I wouldn't blame a lot of people for taking profit on, especially, or descaling, especially if you're a trader. I mean, it's clear this is supply and this was sold before. But yeah, it looks like some kind of great black hole or something in terms of how many trades went through at that point. Again, options were massive. There's a reason why there's a lot of trades there. We'll have to see how it plays out in the next week in terms of whether we continue to see big trades going on. Another one's been treasuries, a huge trade going on through there. And I want to discuss options for a second here because, of course, we saw some pretty big options pinning. We saw 4,700 basically hold the market down, 47 to 47.20. This made a lot of profit for the street in the end. And it wasn't a Max Payne week, but I do think that Max Payne might be having to be kind of put on the back burner because since the advent of zero DTEs, these really have changed the way that hedging markets obviously is happening. 4,800 is an interesting resistance zone as well moving forward, and we'll continue to update you because at the moment it suggests that markets want to go towards 4,800 and then maybe find resistance, possibly even over the next week or 2 weeks, and that would be in line with some of the stats what we've been seeing. All right, let's now go over to options, and it was a huge day. Of course, it was going to be 60% calls, 47.7 million options, and 26% retail trading. You can see here there's a lot of big ones compared to relative 90-day average volume. Some of the things that I think are most notable here is that we still had a pretty good spread between the S&P, so that's very equal kind of options. We also still saw basically Tesla coming out with some strong option call buying, which could suggest that there's a little bit more to run as really the internet gets excited. Remember, this one here, you can kind of tell is traded by retail traders. And one of the reasons is you get a huge amount of single leg percentages. And yeah, there's a lot of calls. So people are getting excited as that thing has just broken out of some of the trading price action, which we'll look at. There were a lot of other ones as well that came out of nowhere. VanEck Oil Services ETF got a 10.25. You can see a lot of people going on the call side here. And yeah, I mean, it's in line with a lot of the things we've been talking about. Enphase, Moderna, a lot of these healthcares and beaten down stocks certainly moving around. All right, let's get into the charts. First off, effective yield rates still going down. That's not a bad thing for markets, so bulls will be happy. What about the bond indicator? Bonds are looking good, so again, markets will be happy. We're rushing through this because there's quite a lot to do. What about US 2-year versus 10-year? Really our read that things are about to get bad. Yeah, it goes up, not down, suggesting that, yeah, it's going to be a little while since we uninvert, which obviously is good for markets. And then you can see here consumer discretionary versus staples on the rise again, suggesting that growth and also the rest of the breadth of market is still improving. We're looking for these to show weakness. What about US 10-year? Well, it dropped through. It's got a little bit more that it could fall down to 3.7 to 3.8 level. And at the moment, yields are 3.9. So this has been great for treasuries, but it is starting to show a bit of a worrying sign considering it's dropping faster than the 2-year spread is. Let's go over here to treasuries. They had a really good movement. Obviously, we looked at this as a supply. We got a little island reversal. It reversed back with an island and then got into the next level. This now has one of the largest trades on it for the last couple of years. And that could suggest that, of course, somebody has sold. And why wouldn't they? I guess they made a lot of money. But yeah, realistically, this still has great stats on it for the rest of 2023 and 2024 overall in terms of how treasuries usually go. Put call ratio dropped back down, almost hitting our yellow line, which is where we start to go very contrarian. This is suggesting that calls are now being bought out of control. Puts are obviously cheap, and that's because no one's buying them. And it does also suggest that if this keeps going down to these points, we need to be ultra cautious with price action because at any point in time, markets could sell fairly drastically. What about home builders? It dropped off for the first day in a long time, but take a look at this weekly candle close. Wow, that thing is parabolic and then some. Now, when it tends to go parabolic, you do usually get a bit of a crash on it later on. The question is when, and as you know, timing is everything. So we're looking for the evidence here. What about the central banks around the world? I almost laugh at this chart. This is ridiculous. Central bank injections increased into this. Look at this. Ridiculous. Across the board, we saw strength from central banks, suggesting that, of course, this flow was absolutely correct and that they really predicted what these central bankers would do. Remember, it's not just about tightening of the asset balance sheet. There's a few things that go into this. But yeah, both the Fed and worldwide central banks are injecting, it looks like, at this stage in terms of liquidity. What about copper? Well, copper didn't quite get through our 3.9, so we maintained that. But it's been a good movement to get back above this level. So if copper breaks out, could be a run for metals into the Chinese New Year, which we will be focused on as well. We've already talked about iron ore several times over. What about the US dollar? Well, the US dollar strengthened, but I've got it on a small time frame here because, of course, here's the supply. Here's technically a bit of resistance. You can see on the futures contracts, there's huge gaps. And at some point, I expect the US dollar to be able to make it back up here because it'll want to go and fill some of those levels. But realistically, it went underneath our little yellow line here. It started to create some structure. I kind of expect it to go like this, maybe then rally, come up. I think it could stabilize, and the main reason is because the US 10Y is so close to that demand level. Remember, 3.7 to 3.8, it's going to be a bigger zone. So watch the dollar, but not just yet in terms of interesting points. What about gold? Well, gold did struggle, and it struggled around our supply level, which we can look at on the left-hand side. And obviously, we talked about this weakening here and going through. So it did go through. That could suggest that rallies are going to be met by sell demand on the small time frame, such as 2032-ish kind of zone. And if we look at the daily, you'll see what I mean, which is basically that the market has come back up into this area here and it's sold that zone. So it's actually engulfed back against it. Now, we expect chop for gold, so this would make sense because what we're kind of thinking about is the gold after this huge rally and then blow off is just going to float around for a bit and then hopefully have a nice resurgence come January. Remember, the stats, which we put in plenty of our previous shows, show us that sideways to down was the expectation moving forward through the month. Oil, on the other hand, looked a lot better. It came back down, rallied back up, made a new high, might sell a few times this week. Looks like it's going for 74-ish a barrel. So that's going to be an interesting zone. And I think pullbacks will be met by bull demand at this point by oil. Some of the oil stocks as well have started to come through, which is an interesting one. Tesla also trading better thanks to the calls. It broke out this downward trend line. Now, you probably could make all sorts of changes to this trend line depending on how you wanted to. And that's why I don't like trend lines too much. But it did break through. Weekly obviously closed above all the previous weeklies. Some interesting levels, heavy trade zone around 257, one to watch for day traders. And then, of course, we've got a watch reaction here alert on 274. So I think that could be two key zones to watch for the bulls on Tesla, but it does look like it's broken out. We reported this and it went up about 1%. So not that much, but we'll see how we go. 10, that is moving forward still, which is, of course, solar. Now, this has come out of the gates very strong. I mean, that was one of the hottest things last week. It might do some consolidation after being so hot, but it does look like 55 to 56 could be a target for 10. We'll find out whether it can do it. Clean energy, a few others coming with it. We also have energy stocks. Now, we saw that oil kind of rebounded after taking a new low. So did energy stocks. And then they came out of the gates pretty strong on Thursday last week. Again, it's kind of reminiscent of a potential base formation. You can see this on things like Chevron, energy stocks in general across the board. So let's go through the warning signs for the bears. Well, I'm going to get a new sentiment upgrade and I'll put it over on X. And this is going to be for retail traders and what they're doing with leveraged contracts right now. But you'll notice here the DAX has been one of the most squeezed markets. It actually put in its first sign of weakness. We've got structure, we have a high, we have a break low, and we have a rally short. Now, if you'd actually shorted the kind of concept of this through Friday, you might have made a little bit of money. So yeah, I guess well done to you to go against such a big trend. But this is realistically the first sign of weakness. Now, to stop such a big trend is not easy. But take a look at that daily. It rejected back with a big wick, and it does suggest some sideways to even downside protection here. 16.4 being the main target for the DAX moving forward. So if the German market starts to fall off, maybe we are in consolidation. The first signs of weakness, not great. Day traders, obviously, you're used to playing a lot of smaller odds. So, that's an interesting one there. But yeah, the DAX showing the first signs of the weakness. What do you think in the comments down below? Another one that hit target was the Aussie 200. Congratulations for the Australian viewers out there. Beautiful inverse head and shoulders. One of the best technicals on the markets. Not the best percentages, but percentages also are based on ratio across the board. So you can see here that we have this huge resistance, this supply zone. The market smashed straight into those and then sold off a bit. So it does suggest, again, another market possibly hitting a little bit of a technical high at this point. The US 2000, as we mentioned before, big trades on it, also hit into the previous highs. 1, 2, 3, 4. Has a reaction off that level. Again, consolidation would be fair to state here. Now, for bulls, what are you looking for? You actually don't mind a bit of consolidation. Reset some indicators, then go through to the bullish side up. If that happens, explosive breakout. Now, for bears, it's going to be a bit harder because you really need to see a lot of traps. Ideally, we would get a smaller time frame Wyckoff distribution here, and then we would be able to therefore see some weakness. But for now, the trend is still up. We still have that 1960 base support. And I think that the Russell is still fairly strong, even though it's hit into a very good technical level where I'm sure some people have pulled off some of their levels and some of their targets. The same thing for the Qs. Looking at the NASDAQ, it's hit into the previous highs. I'm sure some people have down leveraged themselves, have taken profit, have scaled back, have done all of those things. The watching of structure here will be paramount to the next couple of weeks. And while the data suggests that there could be more to come, and of course, the trend action is still very, very bullish on things like the NASDAQ. You can see here, series of higher highs and higher lows. You can keep yourself cautious and on an open alert for these types of levels. The S&P held that 4720 zone. Basically, 4700 was the perfect pin for them. So to have two dojis, especially an inside doji now, I would say maybe an explosive move is coming this week. And that's going to be one that we watch. And do remember the VIX is so low, guys. It is back down in these 12, something we just haven't seen for so long. Like, what a ridiculous VIX, yeah, in times such as these. But anyway, that's what happens. And again, our opinion doesn't really mean much. It's the evidence that we build on the charts. The futures market is the same. Of course, the futures market is going towards these all-time highs, and it's really in the middle of nowhere land at the moment for the S&P. So to grind higher wouldn't be a surprise to me. Do look at things such as 47.38 in terms of breakout levels for going towards 47.76 or 4800. Remember, that's where that options pin is technically for the week ahead so far. So we'll be watching that fairly closely. Let's go over to Bitcoin now. Now, this was a market that obviously got smashed after having such a big strength, got up to 44,500 or 700-ish, then sold off. Then it's kind of rallying and going down and rallying and going down. It's trying to make its next decision. The one thing about Bitcoin is that whatever this rally is tends to usually get sold. We'll do a special on it soon. And then, of course, we've got halving cycle stuff coming up in 24, which we'll talk about it later on. I would like to see the market actually go 46 to 48, then sell off, and then really give us a bit of a better pullback into hopefully a decent opportunity in 24. Let's take a look at the week ahead in terms of the news that's coming out. We do have a little bit of news coming through. Core PCE index on Friday. Obviously, we've got GDP revisions, and we've got some things with housing starts and housing in general, including home builder confidence on Monday. What I would say for this week is I think the price action is going to be the key. And do remember that we are very close now to Christmas. So we're going to start seeing those Grinch results coming through. If you enjoyed what you saw today, then remember to subscribe, smash that like button, and of course, join our free weekly VIP newsletter because guess what? We've got a new one coming out just before the Monday Open, and I'm sure you will enjoy it. Thank you so much. Bye for now.